Mr. Buffett, how can I make $30 billion?
Start young.
Welcome to Retire Rich. Through this channel, we help people learn about personal finance, how to get rich, and retire early. Mr. Buffett's advice is simple but profound. But for average people, what should be done to achieve such a goal? In this video, we'll tell you Buffett's simplest investing advice that can help you turn $10,000 into millions. 1. Start young. We've heard it from the horse's mouth. The biggest contributor to becoming a millionaire is to start young. Sounds simple? Yes, it is. So when you are fresh out of school and have little money coming in, it's natural to think you can't start investing. While that could be true if your expenses completely deplete your income, but it's not true if that's not the case. Mr. Buffett says you need to have a philosophy driving your investments. The first mantra he lives by is you should start investing the moment you have some spare cash, no matter how little it is. Apart from financial gains, it brings the discipline for consistent investing. He recalled in an interview that he bought his first stock when he was 11. He did not begin with $1 million. He just used his allowance and bought 3 stocks of a company called City Service for $38 per share. Yes, that was his first investment, a capital of just $114. So, if you can save just some money after all your necessary living expenses, you can start investing too, no matter how little you start with. Even $1,000 in an index fund can be a good start. 2. Think small. While the first advice is deeply profound, it is not complete in itself. However, Mr. Buffett is not called the Oracle of Omaha for no reason. He substantiates his advice with an example that we all can implement in our lives, no matter how little money we start with.
I probably would focus on smaller companies because I would be working with smaller sums and there's more chance that something is overlooked.
Just like when we go to the market, we buy only that which can fit within our budget. The same rule applies to stock market investing. If we have only $10,000 to start with, we should look for the best stocks we can buy within that. This can mean 2 things. Either we buy just a few stocks of a big corporate giant, or we divide our sum and put it in several stocks of profitable smaller businesses. Both approaches have their pros and cons. While buying the big company stock can be a lot safer bet, its growth prospects are much lower in percentage terms, whereas a small company in a growing phase of its life cycle can give as high as 50% annual return. Suppose a big and established technology company has a market cap of $2.3 trillion, and its average annual growth is 10%. The annual dollar value of such growth is a massive $230 billion. However, even though that is a huge growth for the company as a whole, it will only give you a $1,000 return on your $10,000 investment. However, if you can find out a smaller company in its growing stage, with a market cap of just $300 million, but a growth rate of 50%, then you can earn $5,000 on your $10,000 investment in the same amount of time. Although it might sound very unrealistic, Mr. Buffett says it is not at all impossible. He explains that such high returns exist for smaller, profitable businesses because they are grossly undervalued, and that presents a life-changing opportunity for smaller investors because there are very few other investors competing for that company's stock. Lower competition also keeps the share price much more affordable. However, as we all know, not all small stocks have the potential to become successful over the long term. Therefore, finding such stocks can be like looking for a needle in a haystack. That's when tools such as Investing.com's Stock Screener come in very handy. Using the tool, you can filter stocks by market cap, and once you have narrowed down a few high-growth stocks, you can look into their fundamentals to select those worthy of investing. 3. Stay invested. Another great piece of advice from Mr. Buffett is to stay invested for the long term. He continues with the same example of his first 3 stocks.
I paid the high for the day. That 38 and a quarter was my tick, which is the high for day. And by the end of the day, it was down to 37.
Like any young investor, The moment he saw his $38.25 investment plummeting to $37 per share, he made up his mind to sell it at the brink of the first uptick. Within a few months, he sold the stocks for $40 per share. He made close to $5 profit, but it wasn't a happy story. In a few years, the company bought back these stocks for over $200 per share. So, Mr. Buffett lost about $160 per stock by selling it too quickly. He considers this to be the biggest learning of his investing journey and tells every new investor to not get swayed by every small dip in the market. The philosophy that should drive stock market investing is to think long term, and over a longer lifespan of investment, the market is bound to rise and give you positive returns unless you pick very risky stocks which have no history of making profits. 4. Diversify your investment basket. There is a very popular saying in finance: high risk means high reward. Mr. Buffett is a strong proponent of it. According to him, there is no other way to turn $10,000 into millions without investing in stocks of profitable businesses. And he explains it very simply. Suppose you invest in stocks of growing companies, which are reinvesting all their profits into expanding themselves and becoming more and more profitable. There is no limit to the upside potential of the value of your investment. Even a $10,000 investment can grow into $51 billion, not just millions. But if you are a risk-averse investor and invest all your money in safe yet non-productive assets such as gold, your investment will only grow within the limit of the price increase of such an asset. Therefore, when you are young, your risk-taking potential is high, and if you can come up with calculated risks, there is a huge potential of getting spectacular returns. However, the key takeaway here is to diversify your investment into a basket of instruments, including safe assets such as gold. Once you find the right mix, you can rebalance your portfolio based on your changing risk-taking capacity. 5. Keep investing costs low. We know that breaking down the legendary investor's words can make you think that investing long-term in any stock can make you a millionaire. However, even a novice investor knows that blindly investing in just any stock will never make you a millionaire, even in the long term. This brings the next very valid question in our minds. Where should we invest? In 2008, Warren Buffett entered a bet with Jeffrey Tarrant, the co-founder of one of the top hedge fund companies in the US, Protege Brothers. According to Mr. Buffett, the best investment for long-term investing is a low-cost S&P 500 index fund. However, Jeffrey boldly disagreed and backed his company's actively managed hedge funds. Buffett's argument was that after deducting all costs, fees, and expenses, the passive index fund return will exceed that of the actively managed hedge fund over 10 years. And in 2015, Protege conceded defeat in writing when Buffett's index fund outperformed its hedge fund. One of the biggest reasons for this higher return was that index funds, being passively managed, had a very low fee of less than 1%, while the actively managed hedge funds, on the other hand, had a 22% fee. This high fee structure ate into all the higher returns made over the years, leaving the investors high and dry. Further, Mr. Buffett still backs S&P 500 index fund because it constitutes the top 500 companies of the entire US market. This means 3 things. 1. Your money is invested in top performers throughout your investment span, generating top returns for you. 2. It's automatically rebalanced when the index rebalances, weeding out companies whose performance sees a huge dip. 3. You don't need to put in your time and effort, or even know accounting and finance nitty-gritty to start your first investment. 6. Understand the power of compounding. It is a well-known fact that 99% of Mr. Buffett's portfolio growth came after he turned 50. The hidden reason behind it is the power of compounding. Let us explain it with an example. There are 3 factors contributing to maximizing the power of compounding. 1. Investment span. or time for which you stay invested. 2. Rate of return. 3. Amount you invest. Now, let's show you some mind-boggling numbers. If you want to calculate the same along with us, use any online compound interest calculator. We prefer using the one by NerdWallet because it helps us visualize investment graphically. So suppose you set aside and invest $10,000 lump sum in year 1 at 8% and leave it untouched to let it compound for 40 years. Without even making any additional contributions to the investment fund every year, you will have $217,245.21 after 40 years. But if you stay invested for just 10 more years, your investment will be $469 and $16.13. You can see that the value has more than doubled in just 10 years than what you could amass in 40 years. Similarly, if instead of 8%, your annual rate is 10%, then the same $10,000 investment will amount to $452,592.56 in 40 years, but a massive $1,173,908.53 in 50 years. Just 2% more return can make such a massive difference in your corpus. Otherwise, suppose in addition to your initial investment of $10,000 at the start, you increase your investment by $2,000 every year. Even an 8% return for 40 years will amount to $735,358.25. Compare this to the first case, where you made no annual investments. You only got $217,245.21 in 40 years. So, you can see, every small saving counts. These small additions of $2,000 every year can lead to huge gains over a long investment plan. Therefore, investment discipline is the key factor to turning $10,000 into millions. And if you invest in the right stocks, you can even make billions. Subscribe for more personal finance videos. Turn on the notifications and leave a like to help this channel out.